All right, today we are diving deep into monetary and fiscal policy. And I know, it sounds like something straight out of a dusty old economics textbook. But what if I told you these two forces are actually locked in a kind of hidden dance, one that completely shapes our economy? Let's unravel this thing.
So you've probably heard the classic story. You've got two captains steering the ship of the economy. But what if they aren't separate at all? What if they're so intertwined that they're basically just two sides of the very same coin? That's the big question we're going to unpack today.
Okay, so first things first, let's set the stage with the conventional view. This is how pretty much everyone learns about the two major tools that are used to manage a country's economy.
Right, so here's the textbook breakdown. On one side, you have the central bank. They're the captain of monetary policy, using things like interest rates to keep prices from going crazy. On the other side, you've got the government, steering fiscal policy with taxes and spending to try and keep the economy growing. On the surface, they look like two completely separate jobs.
And of course, each captain has their own set of levers to pull. The central bank fiddles with interest rates or buys and sells government bonds. The government, well, they can change tax laws or spend a bunch of money on, say, infrastructure. Simple enough, right? Well, this is where our story starts to get a lot more interesting.
Because that clean, neat separation we just talked about, turns out it's mostly an illusion. In the real world, every single move the monetary captain makes sends these huge ripples across the water that the fiscal captain absolutely has to deal with.
And here it is, the heart of the matter. When a central bank, say, raises interest rates, that decision doesn't just happen in a bubble. No way. That one action immediately changes the value of all the government debt that's already out there. And it makes it more expensive for the government to borrow more money in the future. See? The two are tied together at the hip through the government's budget.
The key link here is something called the wealth effect. It's a really powerful idea. Basically, when a policy action changes the value of assets you own, like government bonds in your retirement fund, it actually changes how wealthy you feel. And that feeling, that's what directly impacts whether you decide to go out and spend money or save it.
So let's just trace this chain reaction, step by step. 1. The central bank hikes interest rates. 2. This instantly makes government bonds less valuable and raises borrowing costs for the government. That is a direct fiscal consequence. 3. So, regular people, households holding those bonds, suddenly see their wealth go down. 4. And as a result, they tighten their belts, they spend less. And that change in spending is actually one of the main ways monetary policy cools down inflation.
So what does this all mean? It means the fiscal side of things isn't just some passive observer. It's an active, absolutely essential channel that transmits the central bank's actions into the real economy. The two captains aren't just sailing in the same ocean, they're literally tied to the same rudder.
But believe it or not, the connection goes even deeper than just the mechanics. It's also psychological. The effectiveness of this entire system really hinges on one fragile, invisible thing: trust.
This is what economists call credibility. And really, it's just the public's faith that the central bank actually means what it says and can do what it promises. If a central bank says, we're going to keep inflation at 2%, credibility is the measure of how many of us actually believe them. Without that belief, their tools lose a whole lot of power.
This chart here does a great job of showing what credibility looks like. Think of it as a signal. That vertical line is the strength of the signal, and the bottom line is the inflation rate. When inflation hits the target, right in the middle, the signal is at its strongest. But look at how the curves widen out. The further inflation drifts away from that target, the weaker the signal gets, and the faster public trust just disappears.
And look, this isn't just some abstract theory. Take a look at this real-world example from Uruguay. The blue line is the central bank's credibility score. Just look at how it completely collapsed after 2007. And at the exact same time, the red line, that's inflation, stayed stubbornly high. For more than a decade, trust was in the basement. It's only in the last few years, as they've finally gotten inflation back under control, that you see that credibility starting to climb back up. So, why does this matter so much? Well, because a central bank with low credibility has to use a sledgehammer instead of a scalpel. To convince a public that doesn't believe them, they have to hike interest rates way higher than they normally would, which causes a lot more economic pain and a much deeper recession. Which brings us to the ultimate high-stakes game. How do these two incredibly powerful forces, monetary and fiscal policy, work together without just steering the whole economy straight into a storm? To talk about this delicate balance, economists use this fantastic metaphor. They call it the region of stability. This is that perfect, ideal zone where both policies are working together to keep the economy humming along.
Now, the big problem is that the boundaries of this region are totally invisible. You often don't even know you've left it until it's way too late. And these two policies can create some really dangerous feedback loops. For example, super low interest rates can make it really tempting for governments to borrow a ton of money. But then, all that debt makes it politically really hard for the central bank to raise rates later on to fight inflation. If they stray too far, they risk the worst-case scenario, a complete loss of public faith in the entire system.
And the risks of leaving that stable region? They are not the same for everyone. In advanced economies, the first sign of trouble is usually an internal financial bubble, in credit or asset prices. But in emerging markets, the risk often comes from the outside, like a sudden collapse in their currency. A huge spending package in a developed country might barely move its currency. But that same action in an emerging economy could trigger a massive depreciation, creating this awful, vicious cycle of debt and inflation.
So let's bring all this home and really look at the tangible, real-world cost of getting this balancing act wrong. Let's talk about the price we all pay for losing public trust.
Economists have a specific term for this. It's called the sacrifice ratio. It's a pretty grim metric, but it's useful. It calculates exactly how much economic output, how many jobs, how much growth you have to give up to sacrifice just to bring inflation down by a single percentage point.
Now, let's go back to that Uruguay example one last time. This chart shows the sacrifice ratio under different levels of credibility. When credibility is high, it costs about 1.3% of lost output to lower inflation by 1 point. But when credibility is low, that cost skyrockets to 1.9%.
Let that sink in for a second. A simple lack of trust makes the economic medicine almost 50% more painful just to get the exact same result. And that difference, it isn't just a number on a chart. It represents real businesses that shut down and real people who lose their jobs, all because faith in the system was lost.
Which really leaves us with one final big question. In the world we live in right now, with government debt at historic highs and public trust feeling more fragile than ever, you have to wonder, are those two captains managing to work together to find that region of stability? Or are there conflicting moves steering us all toward the edge of the map?